Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, as well as Richard Litton, President of Harbor Group International. We're here to discuss why commercial real estate is a valuable barometer for reflecting the broader trends in the economic landscape and what it suggests for today's environment. It is great to have the both of you with us. Richard, I love getting insight into commercial real estate, known as CRE, because it's certain data points that are not necessarily reflective in the traditional macro reports that come out.
Right. Yeah. No, I think that's exactly right. If you think about the multifamily sector, where Harbor Group is, that's our predominant asset class, and the cost of construction, the cost of properties in terms of renovating. What does that tell you about inflation or trade policy, rents that tenants can afford? What does that tell you about job growth in particular submarkets, and where are the job drivers that draw people to certain apartment communities? So much interplay between commercial real estate and broader economic trends.
And which is so interesting in the multifamily space as well, because we saw such a dramatic shift in migration trends through the pandemic, and now we're seeing some of those reverse as well, where markets that were doing really well are now oversupplied. So there's a lot you could tell even in the personal real estate market.
Yeah, no, that's exactly right. And I think many apartment investors, including us, certainly followed population and migration trends, particularly coming out of COVID, and that did lots of strong job growth in the Sun Belt states, but also it wasn't a secret, and particularly where there was available land, certain submarkets did get oversupplied. I will say we talk generally about oversupply, but real estate is still a very micro granular analysis, certainly for us. So there may be lots of supply, tens and tens of thousands of units in a market like, say, Austin, but there can be pockets in Austin as well where those supply pressures aren't as felt. So as an investor, you have to be so specific and granular about how you think about investing your equity.
And that's a good point, because Max will use the state of New Jersey, because you and I live there. The county that you and I are in traditionally, historically, has had very limited supply. And you can see those pockets, within different areas, even where you're seeing more purchasing taking place for affordability reasons. And that's another good barometer of what's happening in the economy as well.
For sure. I mean, the supply issue up here has been pretty predominant for feels like a number of years. Starting, it seems like, to see that rebound a bit and change, seeing a bit more supply coming on. But as we talked about, it felt like a year or two ago at this point, the supply could be there, but if the price is still not right, and investor and anybody in their home or sitting on assets, they don't need to leave. They're sitting on a super low rate on their previous mortgage they have. They don't need to come down in price. They're going to sit up there, and if the buyers can't come up and meet that number, you're still not going to see any turnover. So that supply is just going to sit there, and it's really not moving. So yeah, there's supply, but it's not the right supply that people are looking for. Like you said, there's the trend people tend to follow. All right, where is it? Affordability, and like you were talking about with with investors going down. It's not really a secret. Everybody kind of sees it's this big, it's open and public information, and everybody kind of goes there, and that changes the dynamic. And it can be quick, where you think you're getting to something that's affordable. It's a place that you can raise a family. You get there, and then now you're in bidding wars, because everybody's looking for those same sort of deals, because prices haven't come down. Again, we're starting to see that change. They're starting, for single-family homes, you're starting to see reports of a lot more supply being out there. We're oversupplied.
Yeah. Affordability doesn't change.
Right. I know they talk like it's canary in the coal mine, but we've had no supply for so long. It's felt like that it might not be such a bad thing to have a bit more of an oversupply, to kind of get prices back in line with the affordability of what people are looking at here. And again, with wages keeping up,
and that's the assumption that the economy and jobs remain strong.
Right.
Absolutely.
So when you look at the CRE data, what does it suggest for the environment that we're in right now?
Well, I think we think a lot about supply, but actually where the supply is headed. And even though there have been a lot of apartments built, and in some cases single-family homes built, that is really cooling off. I mean, I think the data I read recently from 2022 to 2024, there's been a 60% decline in new multifamily housing starts, and certainly an overall decline in the broader housing market that would include single family. And then if you dig deeper and look at housing permits, new building permits, new starts, things starting to come out of the ground, that's really, frankly, fallen off a cliff. So we face, sort of a dynamic, I think, where we already have an affordability problem in the United States and an overall lack of housing, even with all the supply of the last few years. That's going to get worse. It's a policy issue for policymakers and voters and politicians, but it does create some runway, or I'm sorry, some visibility on the supply-demand dynamics that help us think about how we invest and where we want to invest.
Well, the multifamily and apartment sector, that's relatively resilient.
Yeah, I think that's right. It is resilient. Tenants obviously are just signing up for a 1-year commitment. I think some of the strength certainly depends on what's happening in the single-family market. That's another very favorable dynamic for apartment investors now, is that single-family mortgage rates are so high, and we're starting to see a lot of data in our industry of tenants staying longer and longer in apartments because of the inability to purchase single-family homes, either because of lack of supply or the fact that mortgage rates are just simply too high.
Well, what's interesting too, and of course we're seeing this across multiple markets, that you're seeing private capital come in and bridging that gap when it comes to lending, and you're hearing it more within the mortgage and CRE space.
Yeah, that's certainly a product of our inflationary rate environment. Most of the supply that was built was financed by regional banks. They've tended to be across the country the best sources of debt capital for new developers. But with pressures on commercial real estate and particularly regulatory pressures, lenders, traditional lenders, including these regional banks, have really retrenched. We've obviously had bank failures, including in the New York area, by banks of that nature, and that has really opened up a need for private lenders. That's certainly a big part of our business, is private credit,
right,
to help fill that gap.
Which is interesting too, Max, because there's demand for private credit as an alternative investment within one's portfolio to break away from some of that correlation. So if there's investor demand, they're going to develop the product around it.
The product will be there. My only question, I don't know if question, issue, is the correlation discussion of private equity, private credit, any private market. Is there really a lack of correlation, which is supposed to be the feature, or is it just not getting the marks at the same time? You don't have to market, on a day-to-day basis. Yep. Like you're talking about with, regional banks and lenders really starting to pull back. We kind of were expecting rates, again, maybe 18 months ago, we were expecting 6 rate cuts already at this point, and that was for last year. Didn't get that, didn't materialize, so we're kind of in that higher for longer space. So again, if they're the only lenders, if private credit are the only lenders there, and we start to see a pullback and rates going the wrong way and demand is starting to slip, is that correlation really not there? Is there not going to be an impact there, or is it just you're not getting the same marks on that, that same time frame? But again, if there's single lenders where you're going to, and you have to go to private credit because the other lenders are not there, that's a supply and demand issue for those rates. Do they start to climb because they're the only lenders in town? That creates another potential issue there in the long run. Again, just sitting in this kind of uncertain time of what is the regulatory landscape going to be? What are rates going to do? How are we looking out in 6, 12 months? Is there an issue with jobs market,
right,
tariffs potentially? There's still a lot of questions that would think that lenders will still kind of be in that conserve their capital, be ready to deploy it when it's the time, but hey, maybe hold back, and you kind of just limit that, and that puts pressure out there as well.
Well, I mean, the market is always going to climb some wall of worry. Going into 2020, nobody that I'm aware of was modeling a pandemic in 2019. So you can forecast as much as you want, but there's always going to be an outlier to some extent.
Yeah, I think that's right. And the topic of, call it transparency or the private marks and private equity, I think it's also important, at least certainly in our business and in the commercial real estate sector, the counterparties to the different transactions and investments are very sophisticated. We're loaning to sophisticated counterparties. If we securitize groups of loans, those bonds are being sold to very sophisticated bond investors, institutional investors in private equity funds, including ours. They have a seat at the table with our asset management team. They can ask as many questions as they want. So it's certainly not looking at a price every day on a screen, but I think we take comfort in the sophistication of the different constituencies that are investing in this market.
I think that's a big part, the sophistication of it, and who's actually understanding what you're investing in, knowing it. When you
Right.
see the marks, I mean, I traded a ton of OTC products where you're looking at marks, getting day-to-day, week-to-week basis, but understanding what's behind it, and it's not just, hey, look, there's no correlations. What are you actually investing in? And having that sophistication to know and be comfortable with, and the time horizon
And
of
the
it, is it short
liquidity
dated,
and-
Right.
liquidity aspect. If you have to get out, what is it going to be like? Those sort of questions that you really need a bit more sophistication to be comfortably invested in those products versus where it's
Right.
trending
Which is
now
a good
towards
thing. We don't need
retail.
a repeat of 08, 09, and these
For
things
sure.
kind of happen every 10, 15 years because of recency bias and so forth. But
Right.
you note that you're seeing investors remain more critical and strategic
Yeah.
with their approaches.
Yeah, I think so. Certainly, the whole industry lived for a number of years where money was essentially free, right? And it's a leveraged business. But we have lived through now for the last few years, everyone in private equity, private real estate included, a higher interest rate environment that puts pressure. So has put pressure on people's investments. I really think for commercial real estate, you mentioned the wall of worry, and to maybe limit the hours you spend at that wall worrying, it's such a boots on the ground business. It's
Right.
so important to understand the specific real estate asset, whether it's an office building or an industrial park or an apartment property. Who are the tenants? What are the demand drivers? Getting visibility on supply pressures and things of that nature. You solve that first, or you make your risk assessment at the property level first, and then you decide how to invest and where you want to be in the capital stack and how you want to interface with Wall Street on providing liquidity. But start at the property level.
See?
Real estate's pretty simple at its core basic.
That's interesting that you say that because the conversation is certainly around AI and predictable technologies to derive these models. But it's almost like when you look at a home, you can see all these amazing Instagram-worthy pictures on Zillow, Redfin, whatever you're looking at, and then you go and you look at the property, and things kind of sneak
Very
up on you.
different.
Where I didn't see that mold, or I didn't see that crack in the foundation.
Yeah.
So it's still there are some things that emerging technologies can't solve for.
No, you have to go see the real estate. We were in an investment committee this morning on a property, and the transactions team presented the opportunity with pictures, and the questions were, can you see this power line? If you're entering the property, does it not look pristine because this power line's over here? How do you turn in and access the property? How's a tenant going to get there?
Right.
Exactly how long does it take to drive to this shopping center, regardless of what the picture makes it look like? You've got to go see the real estate and understand it.
Okay, when they say 40-minute commute from where you and I live,
Yeah, what is?
well, in what country?
Yeah.
Back to that point, there was a house that is being marketed as brand new. I've been living where I live for 4 years, and it's been worked on since then. And then you look at the picture, and they have full landscaping.
Right, yeah.
There's still dirt on the ground. There's tractors still working on the property. So there's a big nuance between what could be and what
actually
is.
yeah.
Outside of multifamily and apartment, are there other attractive areas within the CRE space?
I will tell you, we do have some office exposure, and sitting in Manhattan today, and the Manhattan office market for Class A office buildings, well located, well amenitized, proximate to public transportation. There have been some great stats out recently that have leasing levels for the right subset of buildings at pre-COVID levels. So I think there are opportunities, selective opportunities in the office sector for the right market. Could be in the equity. We've been more interested on the debt side, because that's a sector where you talk about commercial banks not wanting to lend. Office would be the poster child for that. So we have seen and capitalized on some interesting office credit opportunities just within the last year. But I would say for office, very market specific, very asset specific. Back to my point about it's all about the property, on boots on the ground, and making your assessment based on those demand
I have
drivers.
a question. Have you seen any ramifications so far with the ongoing kind of geopolitical landscape and foreign investors that seemingly, at least in New York, have been a big catalyst behind the upswing in valuations here in New York? Foreign investors that kind of want to park their capital here.
Yeah.
Has that changed in any way recently?
Yeah, great. That's a great question. We're just back. A number of us are back from trips to both Japan and South Korea to meet with investors and targeted investors. I think when inflation pushed rates up, a lot of those investors had some real exposure, particularly in office, and particularly large office positions, mezzanine loans, and things of that nature. And they really had to sort of work through their investment portfolio and you know, did retrench some on investments in U.S. real estate. It has turned. It has turned for the right property or product type, and particularly for multifamily, because all the dynamics I mentioned about supply and forward-looking supply-demand dynamics, those investors see that as well. So if it's multifamily, if it's credit, if it's good cash flow, there is support. We've been very fortunate to have great support from overseas institutional investors.
All right, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining us from MarketSite and Jill Malandrino, Global Markets Reporter at Nasdaq.